Zoltan Pozsar. If you clicked on this video, it's likely for one of three reasons. Reason number one is that you're already a subscriber, in which case I don't know who you are, but I love you. Reason number two is that you saw that Zoltan Pozsar over at Credit Suisse put out a new note and you want somebody to explain it to you. I'm going to do that for you. Or reason number three is that you were looking up clips of You Don't Mess with the Zohan by Adam Sandler, and you made a typo and you accidentally stumbled across this clip, in which case, hang on, this is going to be very riveting, and please hit the like button, subscribe, and share this video with your friends because you're about to learn something about the future of the global economy. Okay, folks, today we're going to talk about four main themes. We're going to start off talking about who Zoltan Pozsar is, why we should consider him credible, and why he's become so popular within investing circles. Secondly, we're going to talk about Perry G. Mehrling's 4 prices of money and how Zoltan has added 3 more prices to turn it into the 7 prices of money. Thirdly, we're going to talk about how Zoltan views the current state of the world, given the recent geopolitical events. And then we're going to wrap it up by discussing how Zoltan is telling investors to prepare themselves and allocate capital, given his forecast of where the global economy is heading. So Zoltan Pozsar is an analyst with Credit Suisse, and he puts out a couple of notes a month where he discusses capital flows and geopolitics and how it all relates to currencies and specifically money, and how our global economic structure is on the brink of changing. Every time we write about Zoltan over at thedeepdive.com, the views we get are insane. It's clear that there is a growing community of people who agree with Zoltan, and they want to know his thoughts on what's happening with the world, both in terms of commodities and capital flows. Zoltan sort of became a legend back in 2019 when he accurately predicted the turmoil in the repo markets weeks before it happened. Since then, according to the Wall Street Journal, many people on Wall Street are referring to him as the Oracle of Market Plumbing and the Repo Legend. Zoltan clearly has the experience to be talking about market plumbing. He previously worked for the New York Fed and the US Treasury. And back in 2008, he famously created a 4-foot map detailing the entire financial system, and the map was then used by regulators to navigate policy back in 2008 when they were trying to figure out the whole housing crisis and how it related to the repo market and the shadow banking system. In 2022, after Russia invaded Ukraine, Zoltan started highlighting his thesis called Bretton Woods 3. In a nutshell, he says we're bound to see the rise of commodities as a primary monetary influence, and we're going to probably see the fall of the US dollar and the rise of currencies in the East. So if you've read any of Zoltan's pieces, you're going to notice that he talks an awful lot about Perry G. Mehrling's 4 prices of money. And if you really want to understand these notes, you got to take the time to understand what these are. So what are the 4 prices of money? Well, we got par, interest rates, exchange rates, and price levels. So par is the price of one money in terms of another money right now. One money in terms of another money does not mean that 2 different currencies are pegged to each other one-to-one. Instead, there are multiple monetary instruments denominated in the same unit that must be convertible into each other. Your bank deposits have to be convertible into physical cash, and you'd expect to get $1 of cash for every $1 deposit. That's par. Now, you might be hearing this going, okay, well, that sounds kind of confusing. And for me, that was the case. Then I stumbled across a Perry G. Mehrling lecture, and it sort of made more sense to me. So editor, roll the clip.
Write down this balance sheet without any complaint. And yet, what do we have here? We have deposit accounts, money, on this side, and we have cash reserves, money, on this side, okay? And we take this all for granted, that they're traded par. That if you have an account at Citibank that says $107, you can go to Citibank and they will give you 107 of these dollars. That's par. That's par. And we see in financial crises, sometimes par is broken. Okay? That your bank money trades at a different rate than central bank money. This is central bank money here. This is private money. So the system is hybrid. There's private money and there's state money. And that hybridity is masked by par. You think like it's just the same, okay? And if the system is working well, it is just the same. But that then begs the question, why does it work well? How do we make it work well? What do we do in the case of a financial crisis? So par is actually quite an important price. And it's key to the payment system. Okay, if you're buying something from California and they said, oh, because you're here in New York, okay, we're going to charge you an extra 5%. There's not going to be, because there's not par clearing between California and New York. You would be really upset. Okay, but this is how it was in the United States.
The next price of money we need to understand are interest rates. This is the price of money today in terms of money tomorrow. Since all banking is a swap of IOUs, it can seem like nothing's happening, but it's useful to look at who's paying interest to who. If you're paying interest on your loan, then you're paying the bank for service. Their IOU to you, deposits, is worth more than your IOU to them, the loan. Interest is what you pay them to get them to do the swap. And the last price of money we have to think about is price level. So this is simply put the price of money in terms of commodities and goods. So Zoltan has actually taken Perry's 4 prices of money and he's added 3 more to turn it into the 7 prices of money. These 3 new categories are foreign cargo, shipping, and protection. When it comes to the price of foreign cargo, the world is suddenly seeing commodity supplying nations making demands on paying for the exports in their respective currencies. Russia is now demanding its exports are paid in rubles, and Saudi Arabia has expressed an openness to paying for Chinese exports in yuan. On the price of protection, with the price of money heavily tied to commodities, its protection and security are expected to influence the new world monetary order. My way of viewing this is that countries with strong militaries or navies are going to pay a cheaper price of protection because everybody in the seas is going to know that they're actually able to protect their cargo. In other words, the world's going to have to start thinking about protecting themselves from pirates as geopolitical conditions become more unstable. On the price of shipping, well, Europe and other energy importing nations are working on cutting off their dependency on Russia. Russia is bound to look for customers in the East, primarily China, through less efficient routes. This leads to a domino effect where China would import fewer resources from a much closer Middle Eastern country, and Europe's going to look to source its energy imports from other producers that have no established efficient routes. So now that we've discussed the 7 prices of money, we can get into Zoltan's current view of the world. So shortly after Russia invaded Ukraine, the G7 froze around $630 billion of the Russian central bank's foreign exchange reserves. Zoltan argues that the moment that this happened, global monetary mechanics changed. One of the things that he's getting at is that we're effectively in a new Cold War. And in saying that, we got to think about 5 things. 1, war is inflationary. 2, war means industry. 3, war encumbers commodities. 4, war cuts new financial channels. And lastly, 5, which he just added in his most recent note, war upsets all 4 prices of money. Zoltan then cites a Bridgewater report saying the amount of government debt that will need to be absorbed by the private sector in the coming months is larger than at any time outside of world wars and the global financial crisis. Zoltan believes that, well, there's $2 trillion in the overnight reverse repurchase facilities to absorb the treasuries that are going to be coming in light of quantitative tightening. There would be a short supply of buyers outside of that. He argues that treasuries have to be cheapened a lot relative to overnight index swaps for the relative value funds to want to play. Well, given that bank reserves are down, they likely will have a preference to tap the funding market instead. Zoltan goes on to say that FX hedge buyers will not be likely buyers either, as they're now priced out, coupled with how geopolitical events last year have fundamentally reshaped global financial flows and reduced large FX reserve managers' appetite for US Treasury debt. He writes, "My sense is that this is a checkmate-like situation. The Fed won't be a pivot and the terminal rate may have to go higher still, neither of which augurs well for either risk assets or treasuries." He adds that hot wars in cold places and cold wars in hot places need war finance, not QT. Okay, so what does all this mean? Well, Zoltan tells us it's going to result in quantitative easing under the guise of yield curve control, which Pozsar believes will come by the end of 2023 or this year. But unlike QE in the context of low interest rates and a risk asset put, the coming QE will be in the context of treasury market dysfunction. Yes, that means that the government is going to get to have their cake and eat it too. They are going to print more money while trying to make the value of that money more valuable with higher interest rates. The next round of QE, Zoltan tells us, will aim to keep the wheels on the cart amid high inflation, growing geopolitical tension, and an ugly financial divorce between the West and the global East and South. So how is Zoltan telling investors to prepare themselves and allocate capital? Zoltan says monetary and fiscal responses were just that, responses to Mother Nature and geopolitics. And with geopolitics getting more complicated, not less, investors should remain mindful of the threat of nonlinear risks in 2023. In saying that, he's suggesting that a 60-40 portfolio, that is 60% stocks, 40% bonds, won't cut it anymore. He believes that investors should move themselves to a 20-40-20-20 portfolio instead, with the weights being 20% cash, 40% stocks, 20% bonds, and 20% commodities. The cash part might surprise you, as Warren Buffett says there is optionality to cash, and as Zoltan says, we should start to think about the risk of non-linear threats. That means that by putting 20% of your portfolio into cash, you are going to protect yourself from downside risk in the other three categories, but also give yourself a little bit of dry powder to go and take advantage of any special situations. When it comes to commodities, William Middlecoop tweets out, during the last decade, most institutional investors had less than 1% invested in commodities. Zoltan is highly influential among institutional investors. This change in strategy will take years to unfold. A long-term commodity bull market ahead. Meaning, if Zoltan is correct in his hypothesis, we are more than likely to see outsized returns in commodities. Here are my thoughts. Whenever we have anybody who has the credibility of Mr. Pozsar and they start talking about a commodity super cycle, the internet is going to go nuts. That is to say that whatever your social media profile of choice is likely going to be jammed with newsletter writers, promoters, and pumpers trying to sell you whatever junior mining deal they have cheap paper in. That being said, it's kind of inevitable that the world is going to create new financial technologies to get around using the US dollar as the world's reserve currency. And these financial technologies or currencies are going to require some form of backing so that two parties can feel safe and secure and confident that large transactions can clear. Commodities are a likely candidate for that backing. All that being said, the world's also in a transition from internal combustion engine vehicles to electric vehicles that's going to require massive amounts of commodities in order to fully transition. So whether it's what Zoltan's suggesting or just the transition to electric vehicles, I believe commodities have a very bright future ahead of them. And when the timing's right and we start to see commodity prices move, the best way, in my view, to get outsized returns is by playing the junior markets, which is a complicated game if you don't know what you're doing. Junior mining is fraught with bad actors and bad deals trying to separate you from your pocketbook. That being said, if you're able to find the lower risk scenarios, you're likely to do very well over the long haul of a commodity supercycle. And guys, I fully intend to share my journey and experience with you in trying to identify those risks and find winners in the junior mining space when the timing is right. All the traffic we're getting on the deepdive.com for anything Zoltan related makes me think that both retail and institutional investors are starting to think that the time is right to invest in the commodity theme. All right, everybody, if you made it this far, I love you. I appreciate you. And I gotta say, please let me know if you think Zoltan's crazy and how you're planning to position your portfolio in 2023.